All right, welcome back after the break, people. So now we'll get started with the next chapter, that is chapter number 9, which deals with dividend decisions. I told you when we started initially FM only deals with primarily 3 decisions: procurements of funds, effective utilization of funds, and also dividend decisions. There were 3 decisions that you encounter in FM: investment decision, financial decision, and dividend decisions. Now, all the chapters which targeted the financial decision and investment decisions we have covered will be now targeting the dividend decision. The funda of dividend decision is, or this particular topic is, how much dividend should the company pay so that the value of the firm is maximized. That's all. Okay, how much dividend should the company pay so that the value of the firm is maximized? 10%, 20%, 0%, what? That's all. Okay, so certain people who would have done their analysis have given their thought process as to what should be the optimal dividend policy. So we'll be going through all of that one by one. Okay, first of all, what does dividend mean? Dividend means what? Can I say it's a part of profit, company's profit shared with shareholders or given to the shareholders? Which profit? PBIT, PBT, sales, contribution, which one? To equity shareholders, you give something known as, or you can give dividend out of each, meaning earnings available to equity shareholders. Okay. To preference dividend, if you're giving means where you'll be able to give it from PAT. But normally in these decisions, I told you, you'll not be able to see much of preference shares because the debt plan will dominate the preference shares plan. Okay. So here in definition, you'll be able to see a part of PAT. PAT as in profit after tax. A part of PAT shared with the shareholders is what we refer to as dividend. Okay. All right. So there could be 2 types of dividend. One is cash dividend. Another one is stock dividend. Cash dividend means, name itself is saying cash dividend. So dividend given in the form of cash. Not just dividend given in the form of cash. You can, if dividend is paid out either in the form of cash or check or demand draft, doesn't matter. Okay. If you have paid it through cash, hard cash, or through a banking channel cash, both will come under the perspective of or purview of cash dividend. It's okay. Cut it off. It's not. You'll learn more about that in CA. Fine. Leave that. It's okay. Okay. It's basically a document. Warrant is basically a document which entitles the holder a particular number of shares. Okay. More in financial instrument topic in India is 109 CA final. You'll learn. Interesting topic. FR not here. Don't worry about that. Okay. Come back over here. Cash dividend. Cash dividend means dividend paid in the form of cash or check or any through banking channel. It is fine. Another type of dividend that you see is stock dividend. Stock dividend is nothing but your bonus shares. Have you heard about this term, bonus shares? Bonus shares means some additional shares given to the existing shareholders free of cost. If you give some extra shares to the existing shareholders at free, you give them the shares to the shareholders but don't collect any money. Such shares we call it as what? Playing my own recording, live recording, and coming to the class. I'm here only, Loda. Okay. Disadvantages of giving all the extra features, I tell you. All right. Bonus shares means shares given at free of cost. Now, by giving a stock dividend, there's some advantages. One advantage to the company is, will there be any cash outflow? Company is giving extra shares to the shareholders. So is there any cash outflow from company perspective? No. So one, you'll be able to save some cash. That is one advantage. And if you give bonus shares, that will not be immediately taxable in the hands of shareholders. If you give dividend in the form of cash, the dividend is taxable in the hand of shareholders, subject to income tax rules, which keeps changing. Now I think they've exempt up to a certain limit. Let's not worry about that. But basically, cash dividend is taxable in the hands of shareholder. Stock dividend is not. So these are the advantages of stock dividend. I think once it had come for around 2 marks. Okay, people. All right. So what are the 2 forms of dividend? Cash dividend, stock dividend. Cash dividend means dividend given in the form of cash, check, bank, demand draft, etc., etc. Stock dividend means you're giving bonus shares, meaning you're giving extra shares to the shareholders and not collecting any money from them. Advantage of stock dividend being, one, for the company, they will save some cash because no cash is going out. If you pay dividend of 1 lakh, 1 lakh cash will go out of company's hands. If you give stock dividend, will the cash go out? No. So there will be cash savings. Two, in the hands of shareholder, it will not be taxable. Okay. Then there is a relationship between the growth rate, or you can find a relationship between, or I had in fact given you this, G is equal to B multiplied by R. In fact, when I had done chapter number 4, cost of capital, I had given you this. I told you for now we'll not worry about it. In dividend decision chapter, we'll prove it to you with number. For now, just write it down. I had told you. What does G mean first of all? Growth rate. Okay. So growth rate, normally when we did chapter number 4, cost of capital and all, we did it by trial and error method, if you just check. Yes, no? First of all, there was a growth. Which formula used growth method? Gordon's growth model, where what, sir? Cost of equity was given by D0 into 1 plus growth rate divided by P0 minus flotation cost plus the growth rate. Yes or no? Able to remember? Yes. So we used the growth rate. There we had found out the growth rate using the trial and error method. Now we can find out the same growth rate through a small formula known as G is equal to B multiplied by R. Okay. B stands for your retention ratio. R is for rate of return on investment. We'll take a small example, prove this, then proceed with the questions. Sir, what does retention ratio mean? Let's say company has an earnings of 1 lakh rupees. Company has earned 1 lakh rupees. Let's say they have given dividend to the extent of 90,000 rupees. They earned 1 lakh rupees, and how much dividend they gave? 90,000. How much have they retained with themselves? 10,000 rupees. Yes or no? Okay. So they earned 1 lakh and they gave away 90,000. So how much percentage dividend have they given? Compared to earnings, tell me. Can I say 90% of the earnings is distributed as dividend? 90. Calculate 1 lakh ka 90% is how much? 90,000. Yes or no? 90% of the earnings company has distributed as dividend. That means how much have they retained with themselves? 10%. So calculate 1 lakh at 10% is how much? 10,000. Yes or no? That we call it as retention ratio. Here the retention ratio is 10%. Okay, 90% the company has given means whatever they have retained, the earnings which the company has retained, meaning the earnings which the company has not given as dividend, we call it as retention ratio. Got this? Everybody, any confusion or okay? Okay. R stands for rate of return on investment. If you're doing a project, means you will expect a return 18%, 20%, 25%, whatever. That stands for your, or that is given by or denoted by R, which will be given to you in the question. Okay. So G, growth rate, is given by retention ratio B multiplied by rate of return on investment R. If you do that, you're going to get the growth rate. Another way to get the same growth rate. Okay, sir. All right. So this gets applicable in some of the problems. Just you need to remember this. Let's try to prove this maybe with some numbers and see if actually if that equation is playing out or what is it. I'll use a study material example only. Just check here. Check the screen. No need to copy anything. There are two companies, A and B. How much capital employed, sir, by both of them? How much is the source of finance for both the companies? 50 lakhs. Okay. In terms of equity shares of 100 each. So that is, the company has only taken equity source of finance, and their earning expectation is how much? 20%. That's what they're earning. Okay. They've invested how much money? 50 lakh, and they're expecting an earning of 20%. So, I mean, you have invested 50 lakh rupees into your business and you're expecting 20% return. So, how much return are you expecting? Return in amount, can you tell me? 50 lakh ka 20%, which is 10 lakh, correct? That is what they've given here. Any problems? Basically, this is your 50 lakh multiplied by 20%. Easy. Got it. This for both the company they told, no? Okay, so that means earnings of B Limited are also same. 50 lakh at 20%, which is 10 lakh. Easy, sir. Okay, proceeding further. Both the company have the same capital structure and the same ROI. ROI as in return on investment. But they have a different dividend policy. Capital employed, return and all is same, but dividend policy between them are slightly different. A distributes 100% of the earnings, whereas B distributes only 50%. A will distribute 100% of earnings. How much has A earned in the first year? 10 lakh. So how much dividend they will give in the first year itself? Entire 10 lakh they will distribute, because they're saying 100% of the earnings they're distributing. So how much has the A retained? 0. Okay, now this is for the last year. Again, let's work out with the current year also, see what happens. Till here good, na? No problem. Yes. How much is the source of finance for A in the next year? Source of finance means capital employed. Capital employed here means your equity share capital plus your retained earnings plus all your debt. All that we call it as capital employed. We have already done this. Have we not calculated ROCE as in return on capital employed? So what is the capital employed for A for second year? Same. How much did they take in the first year? How much money they took in the first year? 50 lakh. Did they say that 50 lakh is repaid? No. Did they retain any profits from the last year, or they gave away entire thing? Full Daralu, Karna they were. Entire money they gave off. So how much is the capital for the second year for A Limited? 50 lakh. Retained earnings is how much? 0. What is the total capital employed? 50 lakhs. Second year also, A ka capital employed is only 50 lakhs. On the capital employed, A is expecting how much return? 20%. So calculate 50 lakh or 20% is how much? 50 lakh or 20%, which is 10 lakh. Yes. Since A ka capital did not increase, their earnings also did not increase. Yes, no. Last year also their capital was 50 lakh. Current year also it is 50 lakh. So last year also their earnings were 10 lakh. Current year also their earning is 10 lakh. Is there any growth rate, sir? 0. Yes, because A ka earnings is same. Can I do a similar exercise for B now? Okay, B ka last year, how much capital B took it in the last year? Or took in the last year? 50 lakh. What is the return they're expecting on capital employed? 20%. So how much earnings did they make in the last year? 10 lakhs. Like A, B Limited distributes entire money as a dividend, or they have a different policy? What does B do? B only distributes 50% of earnings. 50% they distribute, other 50% they retain. Correct? So 10 lakh they have earned. So in this 10 lakh, how much they'll give as dividend? 10 lakh ka 50%. How much will they give as dividend? 5 lakh. So how much will they retain then? 5 lakh rupees. 10 lakh distribute, 5 lakh distributed, 5 lakh retained. This is the scenario in the last year. Now come to the current year. How much equity share capital B Limited had already given? 50 lakhs. Sir, capital employed means only equity share capital or also retained earnings? Also debt. Debt for both these companies is 0. That's fine. Can you tell me second year, what is the capital employed for B? 50 lakh which they have already raised. Plus, how much was retained from the last year? 5 lakhs. So what is the total capital employed for B Limited in the second year? 55 lakhs. Got it, sir? Now this 5 lakh, if it is retained, means will they keep cash? Will they keep idle cash? This 5 lakh rupees I have retained. I will just put it in locker, or I will reinvest it into my business. Reinvest. If I reinvest means, won't I expect some return from that? How much return am I expecting from the project, sir? 20%. What is my capital employed for second year? 55 lakh. On the capital employed, how much return am I expecting, sir? 20%. So how much will be my earnings in the second year? 11 lakh. Yes or no? For A, no. Last year earnings was also 10. Current year earnings is also 10. Was there any growth rate? No. Do the same exercise for B. Last year earnings was 10 lakh. Current year earnings is 11 lakh. That means has earnings increased? Has earnings grown? Yes, from 10 it has become 11. That means can I say there is a 10% increase? 10 lakh plus 10% if you do, are you not getting 11 lakh? So what is the growth rate for B Limited? 10%. Can I conclude like this? The growth rate for B Limited is 10%. Online, offline, everybody is good with this conclusion? Online, give me a response. Growth rate for B Limited is 10%. Comfortable with that statement? Yes. Now, growth rate you can find out through another formula. Easy way. What is that? B multiplied by R. Okay, let's see. B stands for what, sir? Retention ratio. How much ever B Limited earns, no? 50% they distribute, other 50% they retain. B is your retention ratio. So retention ratio is 50%. 50% means, can I write it as 0.5? Are we okay? R stands for return on investment. The return on investment which both the companies are expecting is 20%. 20% if I have to write in full number, it is 0.2. So calculate how much are you getting? 0.1. 0.1 if you want to express it in percentage, how much is it? 10%. Did you not get the same number? Yes. So in our examination, should you have to prove all this, or we'll simply write B multiplied by R? So whenever they give you retention ratio and rate of return on investment, easily you can find out the growth rate. They're just doing B multiplied by R. Everybody got this funda? This will be used in the problems. May not be today. It will come in this chapter. Okay, now that's the funda. All right. If you're cool with this, I'll move on to the next set then. There are one or two small concepts. We'll cover that and then we'll move on to the questions. One, what are the factors that affects your dividend decisions? That we'll call it as aesthetic. Okay. Aesthetic, not aesthetic. Aesthetic. Okay. The factors which affects the dividend decision. So what does A stands for? A stands for availability of funds. First, I will tell you what those are, and then we'll spend a minute to understand that. S stands for your share price or stock price. C stands for your cost of capital. E stands for expectations of shareholders. So we're given where here. T stands for trend in the industry. Okay. All right. I stands for investment opportunities. Another C stands for your capital structure. Right. Not that these are coming much in the examination. If at all it comes, to be on the safer side, know at least 4 pointers. It may come for 2 marks at best. So the factors affecting dividend decision is, we'll call it as aesthetic. We'll go one by one. First is availability of funds. Sir, company has earned earnings after tax 10 lakh rupees in the current year. Okay, there is no preference shares assumed. How much has the company earned after paying tax? 10 lakh rupees. Next year, they want to do some expansion, or they want to do a new project for which they need 15 lakh rupees, or let's say they need 10 lakh rupees for new project. Company has already earned how much in the current year? 10 lakh. Do you think company will give high rate of dividend or big dividend in the current year? No. Why? Because to conduct this new project, they need money. They only have requirement of funds. That means, will they give dividend to the shareholders now? No. That means the dividend that the company pays in the current year may be on the very lower side, or maybe literally zero also possible. On plain side, it looks like the company the company may give a dividend of only 0 because they need money. Entire 100% they may retain. Yes or no? That is what we mean by the first factor, availability of funds. If company itself require funds for their future activity, do you think they will give dividend? So this is one factor which affects your dividend decision. Easy. Next is your share price. At least theoretically it is argued, practically it doesn't play out like that. Theoretically it is said that the company which gives more and more dividend, their share price will increase. Very, very contradictory opinion between books and the reality. It can't be farther than that. But theoretically they say if company gives more and more dividend, their share price are expected to grow. Totally wrong. You go and check any public sector company, Coal India or BPCL, HPCL, anything. They give you very good return. Okay, like dividend only will be in 7%, 8%. The share price you just check. Last 5 years. For 5 years, they would have hardly given 8% in return. 8%, 10% for the whole 5 years. Share price is only increased by 8 to 10%. Coal India and all, in fact, has reduced. 5 years में negative return. Meaning you put the money, you will lose the money. Only money you will get is what? Dividend. Okay. Theoretically, it is argued like that. Practically, high growth rate companies never pay too much dividend. Take any multi-baggers or compounders. Asian Paints, Nestle, HUL, they hardly give you dividends. and people don't buy their shares for the sake of dividend, they buy it for share price increase. Okay. Apple, in fact, I don't remember they paying dividend at all. I think Apple is a stock which hardly gives dividend, is what I heard. I think they have some. I heard that they have no dividend policy or something.
Even MR pays dividend.
Most of the growth companies, see, simple funda. They have money. They want to use that money to expand in this thing. So instead of giving dividend, rather they say, I will increase my share price. Okay. But can we write all that in exam? In exam, what we should write? Our ICA committee. Or ICA books, what is saying? Theoretically, if company pays more dividend, means share price will increase. Write the same. Later go home and laugh. Whatever you want to do, you do it. But it is okay. Now write for the sake of exam marks. Okay, now. So got this S. S for what, sir? Stock price. Okay. Alright. C for cost of capital. Let me go with the same example. Current year, the company has earned earnings of tax of 10 lakh rupees. Okay. Or maybe I'll just go with this different one, maybe or else. Let's say current year, sir, overall cost of capital is 10%. Okay. Remember all this we have done? So current year, the overall cost of capital is 10%. Next year, no, it is expected that the cost of capital will become 15%. It is expected due to economic conditions and other reforms, we are expecting that the overall cost of capital will become 15%. That means if you borrow more money, means company will have a happy face or sad face? Sad face, because they have to pay more, no? Cost has increased. Now, if the company has earned 5 lakh rupees in the current year, would they like to retain this money or give away as dividend? They need money for new projects. They have earned 5 lakh in the current year. They feel overall cost of capital in the next year for new projects will be on the higher side. Will they give away this money as dividend, or they would like to retain this as much as possible? Retain, because cost of capital has reduced or increased? Increased. Because if they borrow, company needs to pay more interest. Yes. So rather company may feel, let's retain this money and use of that one. Yes, no? So that is one of the factors which can affect your dividend decision, which is cost of capital. Based on the cost of capital, you may choose to pay a higher dividend or you may choose to pay a lower dividend. It works both ways also. Understanding what I'm saying or zoned out? Not zoned out, no? It's okay, no? It's only 8:20. We still have 1 hour some chiller minutes. Okay. So we are done with the C. C stands for here what, sir? Cost of capital. E stands for expectation of shareholders. Few people buy few company ka share price or shares only due to dividend. Like ITC is a perfect example. Many senior citizens buy ITC. ITC, you know? Yeah. Many of them buy ITC only because it gives a very good rate of dividend. It gives almost 6%, I think 5 to 6% their dividend rate. Every year, you get a dividend itself in the range of 5 to 6%. Now, in the last few months, ITC ka share price is zooming. Okay. But naturally, if someone bought ITC share means 1 year before and all, people used to say, oh, you bought it for dividend. Like HPCL, any public limited companies, no? If people are investing in public limited company, their main intention is to get dividend. Okay. Suppose some senior citizen invested in HPCL, Hindustan Petroleum. They say we will not give dividend. What do you think will happen? You are shattering the shareholders' expectation. Do you think later on, if Hindustan Lever needs more money, means people will subscribe that company ka share? No. The intention of people buying their share was what? To get dividend. Did you give that? Did you fulfill those expectations? No. Hence, to fulfill the expectation of shareholders also, sometimes company have to give dividend. Now, if ITC gives just like, or if public sector company gives only, let's say Coal India and all, they used to give 8 to 9% dividend. If they give 1%, no, people will not accept it. Because in their mind, one number is already bad. What is that? If I buy this company ka share, aram se I will get 8%. So if you pay less than that, no, people will start selling their shares. They'll not accept it. That means what? Company will decide their dividend policy based on also expectations of the shareholders. Like that. That is your E. Okay, G. T stands for a trend in the industry. Can you go against the trend, or sometimes you have to be with the trend? Be with the trend. Like again, as I told you, the trend is that people invest in government companies only because of dividend. You can't beat that. You have to just go with it. Okay. If the industry if people are giving 2% dividend, means you also will be probably forced to give 2% dividend. So the trend in the industry may also dictate your dividend policy. To what extent is debatable. Theoretically, at least we say we should always go with the trend. Otherwise, you could have some repercussions. People, okay? I stands for investment opportunity. Going back, let's say company has earned earnings after tax of 50 lakh rupees. Current year, how much have they earned? 50 lakh. Company feels they have become lethargic. They have reached the zone like you. They said, how much to do business? I don't want to expand anymore. I'm happy. Suddenly they watched Sadhguru and other spiritual leaders' videos and they said, Santrupta. Okay, like that they became. Alright, so they don't want to do any expansion. They only feel current things they will maintain. They don't want to go into extra things. So how much have they currently earned, sir? 50 lakh. Do they want to expand? Do they have any new project in mind? No. That means will they keep their money idle? What do you think this company will say? Anyway, we don't have any future expansion plan. That means let's give super duper dividend. Yes. So if company has no investment opportunity, means they would like to give more and more dividend, because what's the point in keeping the money idle? Yes, no. So your investment opportunities also dictate your dividend policy. If you have investment opportunities, then company would like to retain the money. If they have no investment opportunities, they would like to give more and more dividend to the shareholders to keep them happy. Like that. Alright. C stands for capital structure. In fact, if you remember, I had told you ideal capital structure is ideal. I had mentioned you something known as debt equity ratio when we had done capital structure. I told you ideal debt equity structure is 2:1. Meaning if you have 1 rupee equity, the maximum debt is 2. This is generally industry accepted norm. It's not that every company ka debt has to be 2 only. Adani ka debt and all, if you compare, I think it is 19, 20, 100 and all. Literally, they are a very high debt companies because it's a high infrastructure companies. That's fine. All right. But generally we say if it's good company, means debt equity ratio should fall within this matrix is what the generally accepted investment norm says. Okay. This means what? If you have 1 rupee equity, maximum debt you can take is 2. Let's say company has a debt of 3 lakh rupees. Company has an equity of 1 lakh rupees. Company has already taken a debt of 3 lakh. They have equity just how much, sir? 1 lakh. So what is debt equity ratio here? 3:1. Okay. Now company earned 2 lakh rupees. Okay. Hang on. Maybe I just modified this example slightly. Yeah. Okay. Company earned a retained earnings of 5 lakh rupees. Let's say. Company or retained earnings. Company made an earnings after tax. The current year, company made earnings after tax how much? 5 lakh rupees. Alright. Do you know ideally what the company would like to do? They would like to get their debt equity ratio in what norms? 2:1, because that is industry accepted norms for this type of company. But currently, are they within the average or gone beyond? Gone beyond. Do you know what the company will do? This 5 lakh, company would not like to give it away as dividend. Rather, they would like to retain. If they retain, what will be the amount of debt, sir? 3 lakh. Sir, equity means only equity share capital or also retained earnings? Retained earnings. How much was the equity share capital already existing? 1 lakh. How much is the retained earnings? How much is the earnings after tax which the company is planning to retain? 5 lakhs. That means equity will become how much? 6 lakh. 1 lakh equity share capital plus 5 lakh retained earnings. So that means what happens to your debt equity ratio? 1:2 or 2:1. Yes. I mean, did they come within this range? Yes. They came within this range. How? By controlling the dividend policy. Fair enough. Like this. So to get the capital structure in place, they may also choose to pay higher dividend or lower dividend. Fair enough. This also could be one of the influencing factor. How much each of them affects is highly debatable. It depends from company to company. Depends on scenario to scenario. But overall, if they ask what are the factors affecting decision making, remember these and call out at least 4 or 5. What are those? SAT. A for availability of funds. S for stock price. C for cost of capital. E for expectation of the shareholder. T for trend in the industry. I for investment opportunities available. Another C is for capital structure. Totally we've given 7 as much as possible, remember. Can I move on to the next set, guys? One last small theory and then problems. Okay? Not end, problems. Stability of dividend. Stability of dividend. Stability in dividend means company would like to stabilize or make the dividend a little bit constant. How they can do it? There are certain policies the companies can take through which they can kind of organize the dividend or stabilize the dividend. First one is constant dividend per share. Company may tell, let's say like this. There is one company A Limited. They have framed a policy. Irrespective of earnings, doesn't matter how much they earn very huge amount or very less amount. This company says we will pay dividend of 2 rupees per share. Every year they will pay on every share how much rupees? 2 rupees. If whether his earning is on the lower side or earning is on the very higher side, the company will pay 2 per share only. Such a policy, what do we refer to as? Constant dividend per share. Irrespective of the earnings, they have kind of freezed their dividend per share. This is one way you can bring in some stability in the dividend. Fair enough. Second one is what? Constant percentage of net earnings. Company could say, or in the second case, let's say there is another company, B Limited. They are saying we don't want to give constant dividend and all. This company is saying how much ever we earn, 5% of that we will distribute as dividend. How much ever company earns, 5% of it we will distribute as dividend. So that is their policy. What is this? Constant percentage of earnings. This way also, a company can make sure that regularly or every year rather they are paying the dividend. Okay, sir. Stability in dividend means you end up paying the dividend every year. Okay. All right. The last one is another policy is constant dividend per share plus extra dividend. Like another company could say, C Limited, let's say. This company is saying every year I will pay a dividend of 0.5 rupees per share. If I do extremely well, I will give 20% dividend extra. So this is their policy. What is their policy? This is what? Constant dividend per share. This is what? Normal one or extra? This is extra dividend. Extra dividend company will only give in the year of prosperity. Meaning if they do good, they will give this extra dividend. If they don't do good means, if they're not doing good means, will they pay this 20% extra? No. That could be one of the policies also. Okay. So these are the 3 policies which the company can employ through which they can kind of stabilize the dividend. Constant dividend per share. How this approach works? Whatever be your earnings, every year you will pay same dividend on the share. Go on paying that. That is constant dividend per share. Second, constant earnings per share. Whatever is your earnings, after on that earning, some percentage you can pay as dividend. Could be 5%, could be 70%, could be 90%, could be 12%, anything. Some percentage. You freeze that percentage and go on paying that percentage on earnings every year. Third year is small constant dividend per share plus extra. Every year you will pay small dividend amount on share. You will pay extra when? Only if the company is doing good, meaning if the company prospers, means company will pay that extra dividend. Otherwise, they shall not pay. So again, these are some policies. Any doubt in this? Anyone? No? All okay? If you understood, you can tell. No need to throw things. Somebody saying, I understood, sir. First tell today's target. 2 questions. Plus 1 homework. 3 questions. 1 homework, I'll leave that. That will not happen. 2 questions. Yeah. Half an hour questions. 40 minutes questions. We'll see. Okay. One you understand. The second one will be become straightforward. Okay. Sir, we have some theories around dividend as well. Just like capital structure, if you remember, there were some relevance theory and irrelevance theories. But dividend also, we have a relevance and irrelevance theory. Irrelevance theory, this guy, you know who's your favorite. You did a lot of arbitrage using his theory. Who's what? approach. Modi, Giuliani and Miller approach. Okay. All right. So, what approach is trying to say? Sir, same arbitrage, sir? No, not arbitrage. Don't worry. Okay. All right. So, what approach says is, is always under which approach? Irrelevance. Relevance theory is arguing that if you pay dividend, or by paying dividend, you can change the value of the firm. Rather, dividend policies affect your value of the firm. That is what relevance theory ka argument is about. Okay, by having a dividend policy, you can alter, or either you can increase the value of the firm or you can decrease. Theory is pretty constant. Sir is saying dividend is irrelevant, meaning whether the company pays a dividend or whether the company does not pay dividend, value of the firm under both the scenarios will be same, meaning dividend will not affect the value of the firm. That is what their approach is, funda is all about. Okay, sir. Okay. Relevance theory, maybe we'll take it up in the tomorrow's session. For now, we're going to concentrate on irrelevance theory, which is approach. Okay. For approach, no, sir has made some assumption, okay, for his theory to kind of work out. First approach is, it is a perfectly capital market. Perfect capital market means information about the company is freely available. Anybody wants it, can access any information. Is it true in today's world? I want Mukesh Ambani ka personal information, or I want Reliance ka every sale ledger extract I want. You wrote a letter. Give me sales ledger extract for 1 month. Do you think they will entertain that? I don't know how you got their email ID, but you got. You sent also. I want April month ka bank reconciliation statement. I want this employee ka salary slip. Will you get all those information? So that means, do you think capital market are perfect? Okay. Few investors, if they want, big investors, they have access to all the information of the company. You and I small, I don't know about you, I'm a small investor. Will I have access to all the information of the company? No. So is it a perfect capital market? When do we say it's a perfect capital market? When there is information is freely available. In today's environment, though, definitely no. So this is first assumption of hypothesis, that capital market should be perfect. Second assumption they assumed is no tax. I think it is there, simply I'm writing over here. We live in a what world? No tax world, dream world. Okay, we live in a no tax world. Probably you're living in Mauritius, Dubai and that sort of countries. Definitely not in India. Okay, so approach will only work if there is a no tax is what they're saying. Then third, they said is no flotation cost. You know what is flotation cost? What? Cost of issuing the instruments. Like if you want to issue equity shares, you may have to pay broker's commission, underwriter's commission. There will be some transfer fees, registration fees that you have to pay and all. Those, the cost incurred to issue the instrument, we call it as flotation cost. And hypothesis assumes that there is no flotation cost or transaction cost. These are the three assumptions based on which they are working. Okay, which looks like, no. Again, this and all hypothesis long, 1958 is Zamana mein. So long before you and I both were born. Okay, maybe in our fathers and great-grandfathers age, that time sir gave this hypothesis, So sir has given two formulas which you need to remember for two problems. Only two formulas, two problems. Simple scenario. You know one formula, what sir told. P0 is equal to P1 plus D1 divided by 1 plus cost of equity. This if you remember. Next two problems you don't need. Formula will not be given to you in the examination. You need to remember. Okay, another formula sir gave is NPO is given by N plus delta N into P1 minus I plus E divided by 1 plus KE. Which sir? Sir, not me. He gave us. Sir gave, which I have tried to remember and put it across over. Okay. So these are the two formulas that you need to remember under hypothesis. I'll just explain it to you what it is. P naught is the current market price. It's all given, okay? Somewhere here only. Same thing I've written over here. P naught, or here only they've told, maybe we'll discuss this. P naught, somewhere there, leave that. First, I will check this. P naught is the current market price. P1 means expected share price. P naught is the current share price. P1 is the expected share price. D1 you already know. D1 means a dividend paid or expected dividend. Expected dividend. You already done all this in Gordon's growth model. D0 means dividend already paid out. D1 means expected dividend. K you already know, that is your cost of equity, which will be given to you in the question. All right. So here delta N, I'll tell you with the help of problem. I stands for your investment, E stands for your earnings. I for investment, E for earnings. Both this data will be available to you in the question itself. So how do you remember this? So I remember it as P1 D1K. And this one as NN pi K. P1 D1K, NN pi K. That's how I remember it. You remember whichever way you want it, but either ways you have to remember. Okay. Formula FFM is all about the formula game. Okay. What? 2 questions if you do, automatically it will come. You already remember so many formulas. No? Add 2 more to the category. What is there? This, yeah, chemical, no? All right. No problem. I'll just give you a minute. Observe this. I'll go through the 2 questions and I'll tell you what this is all about, or we'll work them out. Sir, should we write 2 formula in question? Yeah, we should write. Without knowing, how will you solve the question? Sir, I will copy, sir. That and all don't do in CA exams. Okay? The repercussions are quite bad. I know that you wouldn't do it, but just say. Yes, you've got to know the formulas. Remember them. You have to write them in exam also. No escape. That is where chart book will become more handy for FM. You'll find all the formulas in one place. For now, yes. Can I move forward, people? I'll tell you what is a delta N. Don't worry. This triangle, we call it as in mathematics a delta. How it works, we'll take you through one other question. Come to question number 1. One question, observe properly. Second question is same. Different values, same components. AB Limited belongs to a risk class for which capitalization rate is 10%. So basically your cost of equity is 10% given. It currently has 10,000 shares. Currently how many shares they have? That we call it as N. N stands for currently how much shares does the company have? 10,000. And what is the face value of each share? 100. Okay. The firm is contemplating, meaning thinking, the declaration of dividend of 5 per share at the end of the current financial year. Already declared or to be declared? To be declared. So D0 or D1? D0 or D1? D1. Okay. It expects to have a net income of 1 lakh. This only we're calling it as earnings. It expects to have an earnings or net income of how much? 1 lakh. And it has a proposal to make a new investment for 2 lakh. This is your I as an investment. You remember second formula we wrote I and E. I is your investment. E stands for your earnings. Calculate the value of the firm under 2 scenarios. 1, when the dividends are not paid. 2, when the dividends are paid. In fact, okay. So sometimes they'll not tell MM approach and all. By looking at this data, you should be able to figure out that this is a MM approach because other guys don't use all this. They have their own hypothesis with the different set of data. You'll be able to decode it. Don't worry. And in the examination way, they also clarify. Solve this under MM approach like that, they will say. What is MM approach ka basic funda? Whether the company pays dividend or they don't pay dividend, value of the firm will be same. So when you work out the scenarios under both, when both the scenarios, when you work out value of the firm, it should be same. Here you wrote NPO, that is nothing but your value of the firm. Either you can call it as V or you can call it as NPO. Value of the firm is given by this formula. Okay, one, completely pay attention. So I will solve under the first scenario. What is the first scenario they've given? Dividends are not paid. Okay, let me take up that scenario. Dividends are not paid. Let me do it Aju Baju mein. You don't have to do it aju baju mein. I am just making one. All right. Sir, first, when the dividends are not paid, what is the first formula? P naught is equal to I told P1 D1K. Formula P1 D1 is your numerator, K is your denominator. So P1 plus D1 divided by 1 plus cost of equity. Okay. P naught stands for what, sir? Current market price. P1 stands for expected share price. D1 stands for expected dividend. K stands for your cost of equity. Check the question. Have they given the current market price of the company? They should have given. 1 minute, hang on. I'll just see over here. Is it missed out or what are they trying to say? Actually, one line is missed out, sir. One word is missed out. In fact, given. Sorry, here. It currently has 10,000 shares selling at 100. They did not say 10,000 shares of 100. They use what here? They use the word, one key term. What is that they're told? Selling at 100. So what is this 100? Currently, the shares of the company are selling at 100. So that means this 100 is nothing but your current market price. No, current market price only, we call it as P naught. Everyone okay? They've given current market prices 100. Okay. Let's insert the data that they've given. So P naught is 100 given. Everybody, currently it is selling at 100. So P naught is 100. Correct? P1 have they given? Have they told it is expected that the share price will become 120, 130 like that, given or missing? Missing. D1 expected dividend. Have they told? The company is contemplating to pay a dividend of how much? 5 per share. That 5 only we here only we already called out, which is D1. Yes, which is 5. Can I write? Divided by 1 plus cost of equity. Do you know the cost of equity? Yes, the capitalization rate, the cost of equity is 10%. If you have to write in full number, it will be 0.1. So solve this. 100 is equal to P1 plus 5 divided by 1.1. So 100 you will multiply with 1.1. This will become 110 is equal to P1 plus 5. Therefore, P1 will become how much, sir? 105. Any problem? Basically, we use the first equation to find something known as P1. P1 will be missing. We need P1 for our further value of the firm. To find out that, we need P1. That is not given, hence we use the first formula. Is it okay? If P1 is actually given, no? If these components are given, then we don't need to use the first formula at all. But in these sort of problems, they will give you the current market price, but they will not give you expected market price. So using this becomes kind of a necessity. Oh, in fact, one second. Actually, correct. Which scenario am I solving? I forgot about that. Which scenario am I solving? Dividends are not paid. Sir, dividends are not paid means D1 is 5 or 0? 0. Or can I, instead of modifying this, can I modify this only? Which one you want to modify? First one or either heading we need to change or this we need to change. Heading only will change. So heading means then the dividends are paid. Make that then. Is it okay? So dividends are paid. First scenario maybe we'll solve that. Okay, now it's okay. So if dividends are paid means D1 will be 5 only. Then this calculation will hold good. Everyone cool now. Yeah, people. This is your working note number 1 to find out P1 actually. Working note number 2, if you check there, the second formula. What was the second formula, sir? N plus delta N into P1 minus investment plus earnings divided by 1 plus cost of equity. This was a formula I had written over here. N, do you know in this problem? Yes. P1 did we just now found out? Yes. I, they have only given the investment amount. Earnings as in income, they only given. Cost of equity, you know. Which component is missing? Delta N. So before you apply this formula, we need to know one more component, that is delta N. So working note number 1 is to find out your delta, or working note number 2 is to find out your delta N. I'll tell you what is delta N. First, I will bring some numbers here. So do you know what is the total earnings of the company? How much is the earnings expected of the company, sir? Currently, how much have what is the earnings? 1 lakh rupees. Okay. Company has earned 1 lakh rupees. Which scenario are we solving? Dividends are paid or not paid? Dividends are, no, check, modify. Dividends are paid. Is company paying dividend? Yes. How much dividend per share? They only told the company is planning to give how much dividend? Dividend of 5 rupees per share. Currently, the company has how much shares? 10,000. So if company earns 1 lakh means entire money, will they keep it with itself or they will give some dividend? So what will be the dividend paid? The company has a 10,000 shares. On each share, they're planning to give a dividend of 5. So that means the dividend amount will be 50,000. Correct? Sir, how much remains for the company then? 50,000. So can I say this 50,000 is amount available for investment? Amount available for investment. Can I say like that, sir? Because this 50,000, do you think company will keep it idle or they'll invest? Invest in a project. How much money is available with the company to invest in the project? 50,000. Correct? Check how much amount is required for investment. Check the question. What is the amount required for investment? They told for investment, for new investment, company requires how much value? 2 lakh rupees. Company needs 2 lakh rupees. How much they are left with? 50. Is there any shortage of funds? How much shortage of funds is expected? 1,50,000. Easy. There's a shortage of funds expected. If there is shortage means what do you think company has to do? They have to issue new shares to raise the money. Yes or no? The number of new shares given is what we call it as delta N. Delta means change. If there is shortage of funds, the company will have to give new shares or extra shares. That extra shares we call it as what? Triangle N. The triangle symbol stands for delta, or it is called as delta. Got it, everybody? Come back here. How much is the shortage of funds expected? 1,50,000. How will the company make good of the shortage? By giving extra shares. What is the price of the share expected? 105. That is the reason we need that. Are we okay? So price of one share is 10. Price of one share expected is 105. So what will be your delta N? Delta N, if you want, you can write it as formula. What is the delta N? You can write it as, it is the shortage of funds, or if you want to express it as formula, not required. If you want to express as formula, it is shortage of funds divided by P1. So delta N is equal to 1,50,000 divided by P1. How much is P1, sir? 105. Don't bring this number in decimal. Let this number be in fraction only. I'll tell you later. Let this number be as it is. Don't do any change. Keep this number as like this only. 1,50,000 divided by 105. Okay, if you can bring it down also, but not required. Let it be. Is it going as perfect or you're getting decimals? You're getting this decimal. So no need to bring the decimals. Let it be in fraction only then. Okay. If you're getting a whole number, take it. If you're getting in decimal, keep it as it is. So far, any confusion, anybody? Same thing I'll be putting under second case also. Everyone good? Can we find out the value of the firm then? Can we find out the value of the firm, sir? Value of the firm is given by the formula here. V is equal to, you can call it as V or you can call it as NPO. N stands for number of shares. PO stands for market price. How do you get the value of the firm? If they have no debt, we have already done. Market value of the firm is given by market value of equity plus market value of debt. If there is no debt means market value of equity only will becomes market value of the firm. How do you get market value of equity? Simply take the number of shares, multiply it by price of the share. That is what we are writing it as NPO. N stands for number of shares, PO stands for price of the share. Either you can call it as NPO or simply you can write it as V. V as in value of the firm. How do you think that you get it? NN pi K. So it will be N plus delta N into P1 minus investment plus earnings divided by 1 plus cost of equity. N stands for what, sir? Number of shares. Currently, how many shares does the company have? 10,000. So N is your 10,000. Delta N, did we find out? Yes, delta N is 1,50,000. 1,50,000 divided by 105. Keep it like this one. Okay. Multiplied by what, sir? P1. What is your P1? 105. Why I didn't ask you to take this in decimal means here 105, here 105 will get nullified. No? So why do you want to bring in decimals and make the whole loch out of it? Anyway, when you multiply, these two will get cancelled. So that's the reason I told keep it in fraction. Easy. Okay, minus what? Investment. How much you need for investment? 2 lakhs. Okay, minus I as an investment 2 lakh plus earnings. How much is the earning expected? 1 lakh rupees. So plus 1 lakh rupees. Whole thing divided by 1 plus cost of equity. Cost of equity, they one given in the question to be 10%, which is your 0.1. Solve this. 10,000 into 105. How much? 10,50,000. This 105 will get nullified. So you'll be left with 1,50,000. Minus 2 lakh plus 1 lakh divided by 1.1. So when you work out this whole number, minus 1 lakh divided by 1.1, how much are you getting the value of the firm to be? 10 lakh, no? I'm getting perfectly 10 lakh. Online also people are telling 10 lakh. Check. Everyone got it? This is your value of the firm under which scenario? When dividends are paid. The same thing you have to work out when the dividends are not paid. That's all. Everyone got 10 lakh only, no? Okay. You want to copy? Want me to wait or can I go for the second scenario? Those of you are done can start the second scenario. Substitute different number. That's all. These are all expected numbers. Or scenario you're asking. Huh? These are dividend. First scenario is dividend paid. When the dividend is paid, the value of the firm is 10 lakh rupees. Next, I will solve dividend not paid scenario. Yes, can I start that or anything you want me to zoom in or still copying? What is it? None? Online? Okay. So second scenario. What is the second scenario, sir? Dividends are not paid. Same thing. Okay. Actually, to find out value of the firm, we need P1. Is P1 given? No. So that means we have to use the first component to find out P1. So how do you get P0? P1 plus D1 divided by 1 plus cost of equity. Don't use the same. Here dividends are not paid. No. Okay, P0. Do you know the current market price of currently at what price is the share selling? Yes, 100. That you know. P1 we have to find out, that is as it is. Which scenario are we solving? Dividends are not paid. If dividends are not paid means what will be D1? Will it be 5 rupees? Huh? When you pay, you will pay 5 rupees dividend. Here we are solving dividends are not paid scenario. So D1 will be 0. Divided by 1 plus cost of equity. Cost of equity, they have given it to be 10%. 10% is nothing but your 0.1. Therefore, you're going to get P1 as how much, sir? 110, everyone. Okay. Easy now. Any confusion in this or good? Good. So first working note is to find out the P1. Next working note number 2 we need for what, sir? Delta N. Delta N is check for new investments. You have money or you're expecting to have some shortage. If there is shortage means you have to issue new shares. So new shares issued only, we calling it as delta N. For that, what is the earnings? What is the earnings expected of the company? The earnings expected of the company is 1 lakh rupees. Alright. So from the earnings, company usually pay dividend. So less dividend expected to be paid. We are solving which scenario? Dividends are not paid. That means what is the dividend expected to be paid? 0. So entire 1 lakh is available now. So amount available for investment is amount available for investment is 1 lakh. But do you need 1 lakh for investment? How much is the amount required for investment? Amount required for investment is 2 lakh rupees is what they have told. So are you ending up with any shortage of funds scenario? Shortage of funds. How much is the shortage of funds here? 1 lakh rupees is your shortage, correct now? You can write in bracket 2 lakh minus 1 lakh. That's how we got the shortage of funds. If there is shortage of funds, means what will you do? Give new shares to cover up the shortage. That only we're calling it as a delta N. You need how much money by issuing new shares? 1 lakh. At what price are you, what will be the expected price of the share? 110. So you will recover totally 1 lakh by issuing new shares in the future, and the future mein share price is expected to be 110. Are you getting a whole number or are you getting a decimal? Decimal. So no need to take it further, keep it as it is, because anyway it will get nullified when you put it up in or plug them in your next equation. So working note number 2 is done. Any confusion? No. That means next may what can I find? Value of the firm. Value of the firm is denoted by the symbol V, you can call it, or NP also you can call it. V or NP not you can call it. So how do you get this? Value of the firm is nothing but N plus delta N into P1 minus investment plus earnings divided by 1 plus cost of equity. As many times as possible, keep writing the formula. Don't be lazy there. Okay, the more and more number of times you write, the higher will be your retention power. N stands for number of existing shares. Currently, how many shares are existing with the company? 10,000. That is given. Delta N we have already worked out. How much is delta N? 1 lakh divided by 110. This whole thing you have to multiply it by P1, and P1 we have already got it in working note number 1 to be 110. Minus investment amount 2 lakh plus earnings amount 1 lakh, whole thing divided by 1 plus cost of equity. Cost of equity is 10% or 0.1. Work it out. 10,000 into 110 is how much? 11 lakh. This 110 will get nullified. So effectively what remains is 1 lakh then. Minus 2 lakh plus 1 lakh divided by 1.1. So effectively what are you going to get? This is 12 lakh, 10 lakh, 11 lakh divided by 1.1. So the value of the firm, how much are you getting? 10 lakh rupees. And the first scenario, how much did you get as value of the firm? 10 lakh. Second scenario, how much? That is the hypothesis behind theory. Value of the firm will not change due to dividend policy. Whether you pay or you don't pay, doesn't matter, value will be same. But most of the information they've used is kind of outdated. So, but still, for the sake of exam, good. So you got how to solve this. Lengthy, but any difficulty or pretty usual. Same format, same. Now, anything you want me to zoom in on for the sake of copying, or that also done? That also done means, Papa, you're waiting now. I'll not make you wait. I'll give you immediately next problem. Wait. Question number 11. Those of you who are done can start reading and solving question number 11. That is the last one for the day. Okay. After that, bye-bye. Right, what else? Question number 11. Okay. Homework question also I'll tell you. Wait. This is not homework question. This we will do one more for practice. I know nothing is new, but still we will solve one more for practice in the class. RST Limited has a capital of 10 lakh of equity shares of 100 each. So means, can you tell me N, sir? N is not 10 lakh because this 10 lakh is not a number. It is the value. They told rupees 10 lakh. Company has a total share capital of 10 lakh and each share ka face value is 100. So that means the number of shares is 10,000 shares now. Because 10,000 into 100 only can give you 10 lakh. The shares are currently quoted at par. What is the par value means? The face value. What is the face value? 100. Currently it is quoted. So it is P0 or P1 or what? P0 is 100 is what they are trying to say. Currently quoted. So the company proposes to declare, already declared or proposing to declare? Proposing to declare 10 dividend per share. So what is this 10 rupees? D0 or D1? Expected dividend. D0 means dividend already declared. This is proposed number, so it is D1. At the end of the current financial year, the capitalization rate for the risk class of company is 12%. This is your cost of equity. Compute the market price of the share. Market price of the share is your at the end of the year. Market price of the share at the end of the year is nothing but your P1 that they are asking. Under two scenarios, one when the dividends are declared, one it is not declared. You know what to do for that? Then assuming that the company pays the dividend, and has a net profit of 5 lakh, meaning earnings is 5 lakh, and makes a new investment of 10 lakh, how many new shares must be issued? New shares only we call it as what? Delta N. Use model. In fact, they only asked P1 and delta N, but we will not bother about what they've asked. We will solve everything. We will work out P1 also. We will work out delta 1 N also. We will also work out value of the firm. Under all this scenario, dividend paid, dividend not paid. Work it out. Done means Tata, bye bye, see. That's all. Okay. Practice. I will also be keep working out. You also keep working out on your own. You can keep checking with me in case you're falling apart. Should not be, because this is a straightforward rip-off of the previous question, just with the different numbers. Okay, first scenario. I will not worry about what they're asking. We will solve same. First scenario, maybe I'll take it up as what? We'll solve together. Which scenario you want to solve? Dividends are paid scenario. Okay. First, dividends are paid. P1 given, missing. So we have to first find working note number 1. In fact, this is a requirement in this question, so it's all right. Working note number 1, I'll find out P1. So P0 is equal to P1 plus D1 divided by 1 plus cost of equity. P0 is your current market price of the company. They told it is quoted at par and the par value is 100. So P0 is 100. P1 we don't know. D1, we are solving dividend paid scenario. So the expected dividend per share they are telling is 10 rupees per share. So your D1 is 10. 1 plus cost of equity. Cost of equity, they have told it to be 12%. 12%, if I have to write in whole number, it will be 0.12. So that gives me what? 100 into 1.12 minus 10. I think directly can I write P1 to be 102. So the expected share price at the end of the year is 102. Correct? All right. Working note number 2 is for your delta N. For that, what is your earnings expected? How much is the earnings expected? 5 lakh. Less dividend expected to be paid. Or dividend expected, you could say. On one share, the company is planning to give a dividend of 10 rupees, and currently the company has a 10,000 share. So 10,000 into 10, which is 1 lakh. If you want, you can also show in your notebook how we got this 10,000 also. 10 lakh is your share capital. Each ka face value is 100. Hence, you will get the number of shares to be 10,000. No need to show an exam. If you want in your notebook, you can write down for your reference. So number of shares is 10,000. On each share, 10 rupees dividend. So the total dividend expected to be paid out is 1 lakh. So how much would be your amount available for investment? Amount available for investment would only be 4 lakh. But how much is the amount required for investment? The amount required for investment they've given in the question. Check the last scenario. The company plans to make an investment of 10 lakh. So we need 10 lakh, but we have only 4 lakh. So we are ending up with a shortage of funds scenario. And the shortage of funds is 6 lakh rupees is your shortage of funds. We will make good of the shortage by giving new shares. That only we're calling it as a delta N. So we want to recover 6 lakh rupees by giving new share. And the new share ka price is expected to be around 102. Don't take P naught over here, because this 6 lakh rupees you're not issuing immediately. You'll be issuing in the future. Hence, you should always take P naught, P1 over here in the denominator. So 6 lakh divided by 102. I think again you're ending up with decimals. So let it be. No need to solve that decimal. Can I find out the value of the firm? So value of the firm is given by N plus delta N multiplied by P1 minus investment plus earnings divided by 1 plus cost of equity. N is your number of existing equity shares, which is 10,000, plus delta N, just now we got it to be 6 lakh divided by 102. The whole thing you'll have to multiply by P1, which is 102, minus investment requirement is 10 lakh, plus earnings that you have made is given in the question to be 5 lakh. Whole thing divided by 1 plus cost of equity. Cost of equity is 12% or 0.12. So when you work out 10,000 into 102 gives us 10 lakh 20,000. This 102, when you multiply, it gets cancelled. So you end up remaining with 6 lakh minus 10 lakh plus 5 lakh divided by 1.12. You're getting value of the firm to be 10 lakhs. Huh? Okay. So 10 lakh is the value of the firm under a scenario where you have paid the dividend. Now we'll have to work out the same number when the dividends are not paid. Can I get to that? Or anyone lagging behind or having any problems or confusion, getting stuck? Got it. Okay, so can I go for the next scenario then? Okay, next is a scenario where the dividends are not paid. So first, working note number 1, I need to find out P1. So we have formula for P naught. P naught is equal to P1 plus D1 divided by 1 plus cost of equity. Currently, the share price is trading at 100. P1 we don't know. Since dividends are not expected to be paid, D1 will become 0 divided by 1 plus cost of equity. I think cost of equity was 12%. So 0.12. So that gives you 100 into 1.12 gives you your P1 to be 112. Okay, working note number 2 is for your delta N. For that, earnings expected was 5 lakh. Dividends expected to be paid. We're solving under dividends not paid scenario. So dividend expected to be paid is 0. So the entire 5 lakh is the amount available for investment. However, the amount required for investment is they have given in the question to be 10 lakh. So we do have a shortage of funds scenario. We need a 10 lakh, but we are expected to have only 5 lakh. So shortage expected is 5 lakh. We're going to make good that shortage by giving extra shares. So totally you want to recover 5 lakh by issuing new share. And the new share price is expected to be on one share to be 112. So I'll not go into decimals. I'll keep it as it is. With these two data, we can work out the value of the firm, which is given by n plus delta n into P1 minus investment plus earnings divided by 1 plus cost of equity. Okay, n is your existing number of shares, which is 10,000. Delta n, which is 5 lakh divided by 112. Whole thing you have to multiply by P1, which is 112, minus investment requirement is 5 lakh. Earnings expected is 5 lakh. Investment is 10 lakh. Earnings expected is 5 lakh. 1 plus cost of equity. Cost of equity 12%. So when we solve 10,000, 11 lakh, full number. This into this you're telling. Okay, 11 lakh 20,000. So this 112 will get nullified. So you'll end up with 5 lakh only. Minus 10 lakh plus 5 lakh divided by 1.12. So how much is this? So value of the firm will still be 10 lakh, because under both the scenario you should get the same value as per hypothesis. That's your question. So a little better, able to remember it. So we literally solved 4 questions. It was 2, but we did under 2 parts, so you are able to remember those, right? Just keep revising those formulas so that you remember it. Not only for this, you should also keep revising your old topics things also. Okay, that's I think should be good. So homework today is this also. One more question is there. If you are interested to practice, you can. Question number 15 also same question. I'll give you the answer. If you want, just copy it. You are interested to work out. Nothing new. Dividend paid and dividend not paid wala scenario. So P1 you're going to get here is 105. Here you're going to get is 1010. Delta N you're going to get 3,75,000 divided by 105. Here you're going to get 2,50,000 divided by 110. And the value of the firm that you're going to get is 25 lakh under both the scenario. Okay, this is the answer for question number 50. Homework. Try it out if you want. Now, question number 50. So tomorrow we are catching up at 4. Is it okay, Vasant? Sattapan is okay. Vasant is also okay. Then deal. Confirm. 4 o'clock. Tomorrow we are catching up. Come on time so that we'll try to leave on time. Take care. See you. Bye-bye.